We've all heard that phrase, or if we haven't, it's probably been floating around the ether that turnover is vanity, profit is sanity, cash is reality. What does that actually mean? And what do we mean by those particular terms? If you are in business as a startup, midterm, or you've been going for some time here, you'll come across, you can't escape the world of numbers. And there are certain metrics, certain measures, certain numbers that you'll be bombarded with, encounter. And tonight's broadcast, we're going to have a dip our toe in the water, look at those three particular terms, what they mean, why they're important, and particularly why two of them are more important than one of them, how they're calculated, and why you should be bothered in the first place with what those numbers actually mean. So folks, until then, let us have a little bit of music just to kickstart to the comments accordingly. So what are we going to cover in tonight's broadcast? So first of all, who am I? My name is Mahmood. I have been in business for over 26 plus years, formerly in the world of education, formerly in the world of hospitality, in terms of working in the industry, jumped ship over 26 years ago and clawed my way out of my back bedroom to go to a larger business with the team. So my, I suppose, mission is really trying to get people, business owners, to become a bit more money minded, to become more empowered by getting closer to their numbers and using those numbers in their business to actually improve what goes on up there, the biggest battle you'll ever face in your business, making money, saving tax and time, and creating that business that you want. And I think having a connection with numbers is certainly going to help us in that. So whether you're creative, doesn't really matter what your business shape is, it's really critical that we get a grip on three of those terms here. And accountants being what accountants are, there'll be a multitude of terms that will differentiate certainly the first one. I'm going to start with the first one, and I'm going to illustrate my point here. I've avoided a bit of death by PowerPoint this evening. I'm going to illustrate all these points that I'm talking about by working through a simple illustration to see how what I'm saying in words wise comes alive by way of a number story. The first thing is this idea of turnover. Now, all businesses, whether you are selling time for money, so you could be a consultant, you could be a trainer, you could be selling digital activities, you're selling your services and you're swapping your expertise, your time in exchange for some form of monetary value or monetary consideration. And if you're not, it's going to be very difficult to advance and move your business forward. It's quite possible that when you're selling your services, or if you're a manufacturer or a retailer, you're selling product, you're selling those to a customer. At some point, you want money coming back into your business. And by money, I mean, pound notes, £5 notes, money that flows in and out of your bank account. But it may be that you work with a particular group of clients that say, fantastic, we're buying what you've got to offer, but we're not actually going to physically put money into your bank account in exchange for that until sometime later. Typically, that may happen in what's called a B2B, a business-to-business scenario. So what we sell, that endorphin release, that sort of real adrenaline rush, when we sell something, it's really quite a gratifying feeling that somebody believes in us, trusts in us, wants to buy from us. And that exchange of value is what we might call turnover. Some other financial people give it words like sales. Some other financial people give it words like income. Some other financial people may just call it turnover. They're all in revenue. They're all a multitude of terms. But the first line in the sand, the first marker, is the value of what you sell onto a customer is typically the turnover. If you can get your head around this equation, that what you sell, typically that's broken down into two facets. There's how much of it are you selling and how much are you charging your client. So if you are a car mechanic, your speciality may be doing MOTs. So you may be looking at how many MOTs you get out the door and how much you're charging for each MOT. If you're looking at doing car repairs or something of that nature, you might be looking, saying, I'm swapping how many hours of my time I'm giving to the client, I'm selling to the client, and how much I'm charging them per hour. If I'm in the hospitality sector, I may typically look at that as the number of meals that I'm serving to a customer and how much I'm charging for each meal itself. If you're a trainer, you may be looking at number of courses somebody is subscribing to and how much you're charging for each course. If you happen to be somebody in the logistics company, you might be looking at the number of miles you're traveling on behalf of your customer and how much you're charging them per mile. In my world space, you might be typically charging for each job that you do, a project, a piece of work, whether from accounts or cash flow planning, management accounting, whatever that is, you're going to be looking at what you provide and multiply by a price to that customer. Those in aggregate terms become turnover. Now, turnover, a lot of people understand we pursue that. It's a great metric because it's easy to identify. If you've got reasonably half-decent systems, you know how many invoices have gone out the door, you know the value of those invoices, and if you don't, you should actually get that sorted, so you know the value of what you've sold. And that tends to be, for most business owners, the primary metric, the main figure they keep an eye on. And it's good because it's rough and ready, it's easy, gives us some indication about how we're achieving results with our customers. But actually, in terms of a measure of financial success, a measure of financial progress, a measure if we're getting to our end goal, our end destination, is pretty rubbish, actually. And the reason is because the money that you bring into your business, fantastic, that you generate sales, can't do anything without generating the sales. What we're really looking for is the next two numbers. First one, not in order of priority, but in terms of order that it naturally flows, is the profitability that we're making off that sale. So we may typically, for example, be selling a meal to a customer where we might charge that customer £10 for each meal. We sell 100 meals during the course of the day. That's going to be £1,000 worth of turnover. Brilliant. If it's cost us, though, in terms of meal preparation, wages of our staff, all the associated costs, and it's cost us £900, we made £100 worth of profit. Now, whether that's good or bad, really depends on a number of variables, like, what's your expectation? What should it be like compared to perhaps other people in your sector? What's your aspirations about the profit margin you wish to achieve? So whether it's good or bad, that indicator is a conversation that we need to have with ourselves and our business later on. But ultimately, profitability is what we're looking for, not necessarily the value of the sale. And the paradox is, the perversity is, you can generate a lot of high value sales, those big ticket items, but actually by the time you factor in your own time, the cost of delivering on that particular product or service, actually what's left over is quite minuscule. Whether that's enough to sustain you, to reward you, to invest in your business, is a moot point. So for me, turnover is a very good indication of what to do there, but it's not necessarily a good indicator of anything meaningful. So profitability is what we're looking for. Now, I've just got I've got an excellent question coming up here. I'll come to a natural break at the moment, Abdallah, and I'll address your question about maximising profits. Now, in future broadcasts, by the way, I'm going to drill down into profitability a little bit more. Us financial people, we like to have different numbers that measure profit. The main ones that we're going to focus on in future episodes, but I'll headline to you now, is the profit that you make from providing that product or service, and the profit that's left over after we take into account all the variety of expenditure in our business. So in my restaurant business, I'm looking at the first level of profit, the profit that I generate from selling the food directly, and then I take off all my running costs like front of house staff, menu printing, advertising, rent of the restaurant, and what's left over is that thing. Now, let me just pause for a second now, and let me just bring up a question here. So let me just show the question here. It's a great question. What's the best way to maximize profits? I think it's a good question. And let me give you a very brief answer for this. And if you keep an eye out for future broadcasts, we're going to drill down that in a bit more detail. Now, in terms of what's the best way to maximize profits, well, really, you're tackling two lines here. First of all, you're looking at the value of what you've sold. So one area that most companies and businesses will look to, is there anything they can do in addressing that top line? Can they sell the product for a higher price? Can they sell more of that and generate more overall turnover? That's only one direction. Some people might be a bit reluctant and find that very challenging because it may be a very competitive marketplace. You may not have a distinctive USP necessarily, therefore it's difficult to drive that price up. But that's one area to look at. The other area comes down into costs. What is the cost of providing something to the end client? And really, that's the other angle that you're tackling. Now, the actual specific mechanism for that, there's some very general routes that we can go down, but without actually knowing the finer detail, you either look to control your costs, manage those costs accordingly, and it's not a question of slash and burn, it's controlling costs, controlling income, and making sure that we squeeze the best out of those two variables. One thing I would definitely say, the route in to actually answer that question definitively, it's really critical that you have a good data capture, a good record keeping system to be able to drill down to actually answer those questions. But I hope that's gone some way to answer your question. So let's recap here. Now, turnover, by the way, the reason I fixate on turnover as opposed to sales or revenue is because it's a number that appears in most accounting systems around the world. So when you file your accounts to the authorities, the tax offices, the regulators like Companies House, Carriers Commission, turnover typically is the number that is used as the top line number, as it's called. We talked about we've got to then factor in the costs of running the business, the cost of providing the product and service. And if you don't take those into account, by the way, then you will find that you could be generating a lot of sales in value, but by the time you take costs into account, you can be losing money. And we come to our third metric. And our third metric is on what we call cash. Now, the paradox is, by the way, folks, it is very possible for a company to be very profitable, to make profit, but actually not survive. It's very possible for a company to effectively lose money, not to make profits, but lose money, but actually still survive and prosper and actually gain a foothold in the marketplace. And the reason that is, it comes down to two facets. Number one, how the finance world, the accounting world, actually does what they call measure profit. Now, profit, perversely, is not a scientific number. So if you've got, scary thought, by the way, but if you've got a room full of accountants, which is quite a scary prospect, and you gave them a set of numbers, a set of figures from a company, the same company, each of them could, in theory and in practice, produce completely different figures for profit. And they would all be correct. And the reason is because profit measurement is governed by a framework, but it's largely governed by a judgment as well. Now, just in terms of the introduction to this topic, because I want people, business owners out there, who this is aimed at, to get a feeling for what these numbers are. And as over the next few weeks, we can drill down and we get a bit more familiar and actually get a bit more sophisticated with what we're talking about. But ground rules first, sophistication comes next. Now, in terms of profit measurement, profit is fundamentally a measure of activity. It's an activity the business undertakes, and it's a measure of that underlying financial activity. That financial activity is ultimately measured in currency terms, in dollars, in euros, in pounds, in whatever, but it's effectively a measure of activity, which means it's possible for a company to sell product, to generate a turnover in a period of time, receive no money whatsoever from their customers. They would still have a recorded turnover. They could incur costs during that same time period, not necessarily pay for any of those costs, or perhaps pay for all of them, and compare those two numbers, and then you've got profitability. So profitability has got nothing at all, absolutely nothing to do with money in the bank, how much cash flows in. It's completely irrelevant. So therefore, we've still got to measure. We've got to generate a profit because we've got to create surpluses to reinvest, to make the business sustainable, to carry ourselves forward. The first, and I've left this till last, but it will be the first number that I would suggest anybody looks at, is what's called cash flow. Now, during my 30, 40 years of working in business, I've seen many businesses have a great idea, have a great concept, but what they don't do, they don't actually keep an eye on what I call the cash flow. Entrepreneurs sometimes call that cash burn. So as you start your business, customers may not know who you are. It takes a bit of time for them to trust you, a bit of time for them to invest them in you, to understand what you're offering. In the meantime, you've got costs of establishing the business, running the business. So you're going to have a mishmash. You're going to have like a seesaw, which says costs go up there, revenue turnover is slightly below that line. And therefore, unless you've got the cash to sustain yourself during that period of time, you will find it very difficult to progress forward. So cash, to me, is the most immediate thing in the short term and the most immediate thing in the medium term and the long term. If you've got access to cash and you know that your product or service is going to take time to establish itself, time for you to actually find those customers, time for you to get those efficiencies and productivity going on, if you've got the cash to sustain you, then you will be halfway there to making a success. Many people that I help with, for example, like cash flows, they have a great idea. They get a bit of nervousness and anxiety. They're not quite sure what judgments to make, what decisions to make. A cash forecast is really critical. Cash, by the way, is the one number, if you don't have it, that money in the bank, say goodbye to your business. You won't be able to pay suppliers. You won't be able to pay yourself. You won't be able to pay lenders. You won't be able to pay the things like tax authorities. When you run out of cash, close the lights on your way out. It's all over. You can survive in the interim, not making profits, but you cannot survive unless you have access to cash. And cash is the easier thing to measure in the sense that it's physically what's in your bank account, what's in your petty cash box, your wallets and purses. It's the cold, hard steel, what you can see floating in and out of your bank statement. Cash does not equal profit. Profit does not equal turnover. Those three numbers are interconnected, but they're not the same. Abdallah, yeah, that's my pleasure. I'm glad that was of some use. So let's have a look now. For me, the best way to illustrate these concepts, and there's too much jargon floating around in the world about the world of finance, is to actually have a look at a illustration. What I'm going to do by the power of technology, I'm just going to share my screen and I'm just going to go through a numerical example, folks, of, let me take myself out of the screen. Now, here's the scenario. The scenario is this business is looking at the next 3 months, September to November, and it happens to be a food business. Now, the principles that I'm installing here, by the way, will apply to any business that you've got, whether it's a service business, a manufacturing business, a retail business, a wholesaler, it doesn't matter. The concepts are exactly the same. Now, in our fictional business, we've got 3 dates here, September, October, and November. And the income, the turnover for this business goes from food delivery. So for a food company, they deliver food to their, let's say, their corporate customers. Now here, in this first section, this is looking at the deliveries that are going to be made by this particular company. Now, at the moment, they've set a price after having done their market research and the like of saying that each delivery is going to be charged to the customer at £750 each. Where I use the notion of sterling, obviously any currency will do. The beautiful thing about finance, folks, is that the rules are pretty universal all over the world. I've been fortunate enough to work in different countries, and the principles on which the finance world is built is pretty much exactly the same. From public sector, private sector, social enterprise sector, they all follow the similar set of rules. The next underneath here, I've assumed in this example that each customer is given 1 month in which to pay their bills. So we make a delivery in September. We're expecting to get the money for that in the month of October, and etc. Underneath, I've just literally plucked 2 key costs here. The actual volume of cost doesn't matter. We've got the food costs. So every time we sell and make a delivery, we've got associated food costs, the ingredients, the raw materials, if you want, that go into the food that we're delivering. I'm assuming in this example, by the way, that food costs on average are half the value of the sale. So if I'm charging a customer 750, I've estimated that half that is taken up with the cost of the food ingredients and preparing the food itself. Underneath is the wages of the staff that I've got. And let's just set that to 0. So as each month goes by, I've got an idea about how much time that I need my employees to devote to helping me make this food. So let's see what goes on. So in the month of September, I anticipate that's 1 food delivery that's going to be made. That generates £750. In the month of October, that's 2 food deliveries. And in the month of November, it's 3. Now, whether you are forecasting forward or looking backwards, your systems, your accounting systems, which we'll deal with in another series, but I'll mention at the end, should be capturing this information. So what that means is each month that goes by, I have generated a turnover of 750 for month 1, £1,500 for month 2, and 2250 for month 3. In this example, I've allowed my customers 30 days in which to settle their accounts. So therefore, anything I sell in September, I get money into my bank account in October. Anything I sell in October, I get paid for in November, and November sales do not hit my bank account until the month of December. If I look underneath for the food costs, what we've said is we've assumed there's a 50% relationship. So £750 worth of sales equates to £375 worth of food costs. In the following month, October, same principle applies, £750 worth of food costs in relation to £1,500 worth of sales. And lastly, the cost of food in November is £11.25, the food sales being 2250. Now notice underneath, what I've indicated is that my suppliers, I've agreed, negotiated the same credit terms. 1 month after buying, I will pay them. So the purchases in September, I'll pay for in October. Purchases made in October, I'll pay in November, and November will be paid in December. And lastly is the wages. What I'm assuming is 40 hours of time, and I'm just going to add an extra 10 hours per month as I go through to what the cost of my wages are. And what I've assumed in my wages cost is my staff get paid in the month in which they work. So there's no delay between me using my staff time and actually paying their wages. Now, what does the impact of that all say? Now, if we have a look at the final sheet, this is what the outcome looks like. Now, at the top, we've got 2 lines here. Let's label these up. This first column, just unprotect that, folks. Now, this is where a live broadcast means what I've done. I've protected my worksheet and I've actually locked the title, which is not a very good thing to do. I thought I would have, there we go. Right. Okay. So what we've got here is, in this fictional example, if I look at this column here, now should we do a bit of color grading? Why not? Let's mark that yellow. In the yellow section, what we've got is that's the cash that's coming in from food delivery, 2250. Compare that to its neighbour. The turnover, though, would be recorded at £4,500. Turnover, by the way, sometimes is called revenue, called sales, called income. I personally speaking prefer turnover. So 4,500 is the value of the turnover, 2250 is the cash. What we might immediately see is that actually we've got another over £2,000 waiting to come into our business, and that's going to cause some pressure potentially on the business. Underneath, look at the cash. The cash for the food is £11.25 and the wages is £1,500. Now, if we look down here, excluding anything else, our bank balance would record a deficit, an overdraft, a negative figure of 375. That would be what our cash profit would actually be. Now, however, in purist terms, in looking at it as an activity, that's not the true profit the business has made. The true profit the business has made is the overall value of the turnover, 4,500. The total of all the costs it's incurred, 3,750. So the business has actually made a profit of 750. The bank overdraft wouldn't actually tell us that, but a proper measurement of profitability would actually reinforce that. Now, if I look at the difference between those 2 numbers, I see there's a difference here of 1125. The cash recorded a negative profit of 375, a loss. In true terms, it was 750 profit. Overall, that's a difference of 1125. And the culprits are down here. It's because we're waiting for another 2250 from customers. We've got a delay on our supplier accounts, and the combination of those 2 factors has contributed to that difference between cash profit and the correct profit. Let me just turn this screen off for a second. Now, what can we conclude, folks? Well, the key thing is Be familiar with what those three metrics are. The phrase that I said at the very beginning of the session, turnover is vanity, profit is sanity, cash is reality, reinforces that. Turnover is a good, easy, rough and ready measure, but you really want to be focusing on profitability and cash flow in your business. Cash is the most important one. Without it, the wheels of your business will not continue to turn. The lights have a risk of running out and having to be turned off as you leave the building. You can, as we'll see in future broadcasts, by the way, the real true power of these numbers is to go behind under the bonnet and actually look at the different products and services that you sell and actually analyze profitability for those individual product groups and services. So folks, I hope you found this useful. I hope you found this value. Obviously, if you've got any after comments, please leave them accordingly. If you like the video well enough, obviously I'd love your feedback, likes and shares. If you know people who might benefit from this, please do share. Until then, folks, have a fantastic week from me. I look forward to seeing you guys next Tuesday, same time, 6 o'clock. Why don't we play out with some good music, if I can figure this out. And there we go, some out.